Hello, and welcome to the Balancing Act podcast with SingerLewak. Today, we are sharing our third and final installment of the International Business Insight series. We'll be exploring the topic of remediation options, an essential aspect for any business. Joining us are tax directors Stephen Bolt and Daniel Trousdale, and international practice leader Robin Park. With their extensive experience in international taxation and tax planning, they will provide valuable insights into this important topic.
The real goal of the remediation effort is really just to bring the taxpayer into compliance and minimize the impacts of these penalties and interest that the IRS can assert. And the most common and easiest way to move forward with a remediation strategy is really preventative measures, right? We want to get ahead of this ahead of time so that way we're not looking backwards. And so, Stephen, do you mind sharing a little bit more about some of these preventative measures and potentially identification process when it comes to foreign filings?
Yeah, Daniel. So to your point, the best course of action is to avoid non-compliance altogether. So there's a few key areas that a taxpayer can focus on to improve their compliance performance and make sure that they're satisfying all their obligations. The most important thing, number one, is just identification. So each taxpayer, needs to have the ability to identify all of their compliance filing obligations and tax that they owe. And as we mentioned, this could be applicable at the federal level, the state level, or in foreign jurisdictions if foreign operations are being carried on. To correctly identify filing requirements, all aspects of an ownership structure and business need to be considered. So, for example, for a multinational organization, you want to look at everything holistically, and applicable tax filing obligations should be identified for each entity in the structure, each shareholder in the structure. Anything that your business has responsibility over, there's potential filing requirements. And, as I mentioned, organizations active in foreign jurisdictions could have obligations in the relevant foreign jurisdiction where they're operating. Note also that various U.S. tax filing obligations could exist even for small minority interests owned in investments. So even if you own, 1 or 2% interest in a foreign entity or joint venture, there could be tax filing obligations associated with that ownership.
Yeah, it seems that at times taxpayers who have minority shareholders oftentimes disregard the impact to these other stakeholders in their business. And I think that it's important that we emphasize that point, that even those that have a smaller interest in a business still have a material reporting obligation potentially for the activity of the business. And I think sometimes we get comfortable with sort of lower ownership interest and we think that, this wouldn't apply to me because I only own 10%. And oftentimes that's not the case.
Yeah, it's often an afterthought, the small stakeholders, or, if you own only a 1% interest in an investment, it just appears immaterial or not important. But, as we've talked about, there could be filing obligations that carry significant penalties if they're missed. Another area to consider when you're, looking at various tax filing obligations is any extraordinary events or transactions that may have occurred during the year. So, you could have acquired a new business or company. You could be making payments to vendors or shareholders that require withholding tax and reporting. There could be sales or VAT tax in a foreign jurisdiction that requires reporting. And oftentimes there's, related party transactions where you have to report on an international informational reporting form. Careful planning in advance of transactions is helpful also in identifying applicable filings, and something that definitely needs to be considered on an ongoing basis. A third area to consider is just assets that are held by a taxpayer. So there's various U.S. international reporting requirements for ownership in foreign corporations, foreign partnerships, foreign bank accounts, assets. And so it's important to consider, along with this general thing that we've been discussing, everything holistically needs to be considered, all aspects of the business. in order to identify your tax filing obligations. It's also critically important to work with your tax advisors to, as part of this process, right? So you have to make sure that your tax advisor has the capabilities to advise you on the issues that your organization is facing. The advisor does not have requisite skills or capacity to advise, holistically on the issues that a taxpayer is facing. It may also be necessary to utilize multiple advisors, right? So if you have operations in a foreign jurisdiction, you may need to hire an advisor in that jurisdiction in order to advise on your obligations in that foreign country.
Yeah, I've actually been on both sides of this, Stephen, where even with a background in international tax, there have been issues. I just haven't had the experience working or understanding local law, understanding the impact of that from a U.S. reporting perspective. And so as a tax advisor, having the ability to and wherewithal to identify your own educational limitations and experience limitations to rope in somebody else is extremely important. And as a taxpayer receiving services from a tax advisor, it's important that you evaluate this, that you see is this the collaborative type of environment that your tax advisor is maintaining with their contacts, so that way you're getting the highest quality service that you can in the marketplace for what you're asking of them. I guess I would like to mention here is working through as a tax advisor. There are strategies that can be put in place for these identification processes, like Stephen had mentioned, around just looking at a balance sheet, right? Looking at what assets does the company actually hold. And you'll find that if you just take the few extra minutes or a little bit of extra time to just reason through what those financials look like, it really does bring to light a lot of the issues that this taxpayer or the client could be facing. So just, little tips and tricks to keep the taxpayer at the forefront of all the service that's being provided.
That's right. And it's a team effort, between the advisor and the taxpayer, right? So there should be, free sharing of information. Both sides should be on the same page to accomplish the goal of, making sure that the taxpayer is compliant with all their obligations. And, obviously setting up a plan and a timeline with your tax preparer is key to make sure that all information is ready and available when it's needed, and that everything's identified in a timely manner. So Robin kind of alluded to this earlier, but oftentimes there's legislative changes or proposals that could affect the taxpayer. We need to stay up on the latest developments to make sure that we're identifying any changes that occur. In the example Robin mentioned, there were filings triggered with the change in law that resulted just merely because of the law change and not because there were any changes to a taxpayer structure. So all these filing requirements were created with the same structure in place. So it's just very critical to stay continually educated on the latest market developments, the latest laws affecting your business, proposals that are being floated out there to stay ahead of changes that could occur. So all just factors to consider when you're thinking about identification of your compliance filing obligations.
Well, what options does a taxpayer have in the marketplace to actually move forward with remediating any issues that have been identified? And those options really depend on the facts and circumstances that the taxpayer finds themselves in. But there are multiple strategies that we have tried to guide our taxpayers throughout our years here at SingerLewak. And so hoping to walk through a couple of these options here on the podcast today, with the first being requests for what are called relief under reasonable cause. So taxpayers can oftentimes seek penalty abatement by providing their that their non-compliance was not due to any sort of willful neglect, right? It's sort of a plea of ignorance to a certain extent, which is oftentimes a position a taxpayer finds themselves in. Their tax service provider didn't have experience on the matter. They've used the same CPA for 20 years. and so the issue was just never discovered. And so under the reasonable cause method, generally there are specific criteria that the taxpayer has to meet that are dictated under certain IRS regulations and under the Internal Revenue Manual. And as long as you meet these simple, sort of 3 or 4 criteria, the taxpayer may be able to experience some relief through reasonable cause. The second more common method for getting penalties removed off a taxpayer's account through remediation is first-time penalty abatement. So we like to think as kids growing up that we're learning as we go throughout life. And so the IRS sort of maintains a similar ideology with respect to tax compliance. They understand that from time to time, a taxpayer is going to make a mistake. They're going to do something that is not within the confines of U.S. tax compliance. And at times that can be okay, right? From the viewpoint of the IRS. And so they offer an option to remove penalties off a taxpayer account if the taxpayer can prove that they've never engaged in this type of action before, they've never had a failure to file a tax return or a failure to pay an estimated tax. The IRS sort of rewards this first-time error with a one-time abatement. It's sort of a one-time use. You get it once, and then if you make the mistake again, you're sort of on the hook for what the IRS asserts on your account. And so these generally are more advantageous. Claiming this first-time abatement is for taxpayers that have had a clean compliance record in the past. That will just explain to the IRS why we believe the taxpayer would qualify under a reasonable cause or first-time abatement argument. We'll generally attach that in response to a notice or to a tax return that gets filed. So if you find yourself in a situation where you believe reasonable cause or first-time abatement might apply, consult with your tax advisor on the method for claiming that relief, which will generally be a formalized tax memo that just gets sent in response to the IRS. And correcting delinquent returns by maybe amending a return and including the missed filings, or using an approved disclosure program, and maybe you just don't contact the IRS directly about it, but you just move forward with correcting the issue yourself. Oftentimes, this can prove to be a successful avenue in remediating a taxpayer's non-compliance. However, it can result in greater risk of penalty, and in some very, very small circumstances can result in criminal charges. So we generally won't advise this as international tax specialists for getting our clients into compliance, but just note that it is an option, and some taxpayers do just opt to correct it or correct the issue moving forward and hope for the best. But we generally don't advise this. Addressing these issues before the IRS gets wind of it, right? As soon as they get wind of it, it seems like the options you have they shrink pretty severely.
If you're more reactive as opposed to proactive, you are fighting an uphill battle, and your remediation options are severely limited. It's imperative that the taxpayers consult with the tax professionals, and they come forth before the IRS discovers any of these delinquent U.S. international tax filings. There are avenues to get relief on a much more economical basis, right? So we could potentially eliminate any failure to file penalties, and greatly limit the offshore penalty that we just discussed, and also more importantly, if we comply with this, then the statute of limitations starts running again, so that the IRS can only go back under the normal statute of 3 years, as opposed to it being open indefinitely if they don't take any remediate actions.
Taxpayers can find themselves in, like we've talked about, a whole array of circumstances. And one that might even be more common than we would think is when a taxpayer just simply cannot pay their tax debt. I know that there was this chime on the radio that I used to hear all the time growing up as a kid when I'd drive in the car with my friends or with my family, and I hear Optima tax relief, right? And I never really knew what that was until I actually got into the accounting field, particularly in tax. But really what they are advertising for is one last remediation option that taxpayers have, which is called an offer in compromise. Offers in compromise, generally, it's this sort of smaller program that the IRS has that's specifically set up for taxpayers that are unable to pay their tax liabilities in full. And the program's allowable for both individuals and businesses to settle their tax debts primarily for amounts less than what they owe. So for taxpayers that are maybe tax delinquent, they haven't filed tax returns for a long time, their business is going under for whatever reason, the IRS does have an option to enroll in this offer in compromise program, and it generally is available for taxpayers that meet certain criteria. And the criteria, the main criteria, it's sort of like an either or. And there are three primary criteria. One is if there's a doubt as to whether or not the IRS is going to be able to collect any tax from you. The IRS may believe that you're in a position to where they're never going to be able to get payment from you. And I think it's usually a 10-year assessment that they'll put on your account. The second criteria, I believe, is related to the correctness of the tax liability. So you as the taxpayer may not agree to the IRS's assessment of tax on you. And if you come to a disagreement with the IRS and you cannot come to terms on it, the IRS may be willing to budge and take a lower tax liability than what is assessed by them. And lastly, it could just be a product of tax administration. There are exceptional circumstances that exist, such as financial hardship or other equitable considerations that may justify a taxpayer not paying their tax liability in full. And so this is another area that is available in the marketplace. I don't believe that SingerLewak LLP does a lot of offer and compromise situations. There are firms in the marketplace, such as Optima Tax Relief, that build their entire business model on assisting clients with these remediation efforts. So if you find yourself in a circumstance like this, just know that there is another IRS program that is available.
And emphasize proper identification and maintenance of your compliance plan. Working in conjunction with your tax advisor is the best course of action you can take to avoid misfilings and penalties with the IRS. So if you take nothing else away from this, just take this away. Make your plan, work with your tax advisor, make sure you're considering everything in your business, and you'll be on your way to hopefully avoiding these, sometimes nasty penalties that the IRS can impose.
That wraps up our discussion on remediation options. We hope you found this episode of SingerLewak's International Business Insight series informative and insightful. If you missed our previous episodes, we recommend giving them a listen. We covered cross-border M&A transactions and the complexities of transfer pricing. Thank you to our listeners for tuning in. Stay tuned for next month's episode, and don't forget to subscribe to the Balancing Act podcast with SingerLewak so you don't miss an episode.